New age NBFCs like lending fintech and peer-to-peer lender serving the underserved and underbanked customers needs a further strengthening of regulation in the light of new challenges thrown up by the pandemic. 4 months ago, the RBI had raised a red flag citing some shoddy practices like charging high interest rate, harsh recovery method and unauthorized use of personal data of customers. Post the pandemic, the problem of new age NBFCs have only compounded. There could be many fintech failures as funding is drying up and their book is full of risky borrowers like non-salaried customers, self-employed and micro-entrepreneurs. Globally, the failure of German fintech Wirecard has already exposed the weak links in the compliance and auditing area. The accounting fraud and the payment fintech Wirecard has woken up the global regulator on the need for more oversight and surveillance. In fact, the regulator should be more proactive now in filling the regulatory gaps than waiting for a crisis to happen. The first big area of concern is the liquidity or the limited funding sources. While the banks have access to low-cost funds and stable borrowing like salaried class, these new age NBFCs are facing dual challenges on both the liability as well as the asset side of the balance sheet. The liquidity management issue can be handled in two ways. The RBI should offer some indirect help. This support could be by way of RBI's special liquidity window to commercial bank, which in turn could lend to these players for a short period of 1 to 2 years. Another way is to set higher liquidity ratio requirement for these new players given the limited sources of funds available to them. It is also time now for RBI to do an asset quality review of these NBFCs. This will reveal the likely bad loan problem and the need for corrective action by insisting on higher provisions in the books. Rating agency CRISIL has recently estimated the delinquencies in the entire NBFC sector to increase by 250 basis points in the current fiscal. This ratio could be much higher for the new age NBFCs. The weakness in their portfolio also comes from the geographical concentration, as many of these NBFCs are focused on a single geography. There are also single product NBFCs operating in the MSME loan or lending to gig workers or in the supply chain finance. The size of the loan is also very important, as most of these loans are small ticket size loans from Rs 5,000 to a lakh. In the post-2008 global financial crisis, many NBFCs had shut shop because of small ticket size loans to self-employed and also the unsecured nature of the loan. In fact, some large NBFCs like City Financial and Fullerton had to change their business model. Like they say, in the midst of every crisis lies a great opportunity. A comprehensive review of operation of these NBFCs will certainly provide new insights on how these models are working, their credit appraisal systems, the gaps in risk management, level of auditing, compliance culture, and also the governance framework. A timely intervention by the regulator will not only create a strong fintech universe but also help in achieving the financial inclusion objectives.